Hello guys, and welcome back to another video. In this video, we're going to talk about swing projections for market structure targets. So let's talk about the long-term perspective and market structure breaks. Before we can start to use swing projections for targeting, all the steps shown in episode 1, 2, 3, and 4 must be present. Swing projections are the last key step to trading with clarity. They will give you profit objectives to aim for. So here we're on the long-term perspective, and specifically we're going to look for market structure breaks to start looking for swing projections. So we start from the long-term perspective, and we want to identify when the market is ready to reverse. So if we look here, price has retraced back from this dealing range high to this dealing range low. Price has found some internal range liquidity, and we're blending that with a fair value gap. Right, so this is a high probability fair value gap because we have an internal range liquidity pool, and we have premium conditions, and we have the fair value gap itself. When the market is ready to reverse, this will be confirmed with a significant market structure break. So since we're looking at a resistance level, price will rally into the resistance level, and when that rally is ready to reverse, when this bullish trend is ready to reverse into a bearish trend, we can confirm that it's ready to reverse with a significant market structure break. So, a significant market structure break is the invalidation of a classical or rebalanced intermediate term swing point. This is why interbank market structure is more detailed than retail market structure. So that is the same fair value gap mentioned in the previous slide. Sure, we have market structure break here and market structure break here, but if you want to see the full trend reverse, something similar to this, if you want 100% conviction that it's going to reverse, you want to see a significant market structure break, and that can be seen with breaking a classical rebalance intermediate term swing point. So here we have a fair value gap, price rebalances that, forms a low, then rallies into the resistance level. Sure, these are little market structure breaks, but if you want to see this trend reverse, this entire trend reverse, rather than just looking for a little day trade or scalp, make sure that you're basing that off a significant market structure break. After a market structure break is shown, we can then start measuring swing projections for targeting purposes. There are two dealing ranges to use for swing projections. We can use either the parent price range for a measured price leg, or the failure swings for a measured price swing. So let's talk about the measured price leg. So a parent price range consists of a long-term high and low, and was used to create or cause a significant market structure break. So that's the same fair value gap as used in the previous slides. This is that market structure break, and this is when it started retracing. Okay, so this is the long-term high because it hit that long-term perspective level. This is when it started retracing back to the range. So this is the long-term low. We're going to expect this to break in the future, but we're going to use this price range, a premium discount, and define levels to take action on so we can target this low and many lows to come. So the goal for a measured price leg is to see a one-to-one extension of a parent price range. So here again is where it starts to retrace back into a premium. The parent price range is a price range that reacted off the high time frame fair value gap and caused a significant market structure break. That range, we want to mark that out, long-term high, long-term low, and then we want to extend this out for a one-to-one extension, and that should be our first profit objective. Then the goal for swing projections is to blend that with price levels. So if you really want to get precise, make sure to blend the extension with a price level to the left of the chart, and you want to be using liquidity, order blocks, or fair value gap. Price can far exceed the one-to-one extension, especially under the context of the long-term high. So the context of the long-term high was we wanted to see the market reverse from bullish trend to a bearish trend, and that could be confirmed with a significant market structure break. We then want to use the parent price range and aim for at least a one-to-one extension. But if we understand that the context of the long-term high is to fully reverse price, especially with the narrative and context from the monthly and the weekly chart, then price can far exceed a one-to-one extension, okay? Especially if it wants to go lower, especially when there's equal lows here and we want to complete this market maker sell model. So just have one-to-one extension as an objective for profit taking. But know that since a long-term high is formed, those highs are going to stay for a while, right? That's going to act as the source of parent order flow for bearish move to come, right? If we get the one-to-one objectives, we can start aiming for 1.5, 2, 2.5, and we want to blend all these swing projection targets with price levels. So here we're in the discount market. We want to sell high and cover that at a discount, right? That's good trading. So we're going to use the swing projections and we're going to find, okay, what levels are in a discount. We have low here, swing low here, swing low here. So all of this is internal range liquidity because it's inside this range from this low to this high. We then have an internal range liquidity exit in terms of fair value gap with a 2.5 deviation swing projection. And we also have this clean lows, which is external range liquidity. We can blend that with 3 standard deviation swing projection. Alright, so we're blending these swing projections with price levels, and we want to see it at least hit 1, but under the context of this being a long-term high and the market wants to trade lower, then we can aim at these accordingly. So a reminder, the closer we get to targets, the more oversold, overbought price becomes. Therefore, it's important to have short-term objectives along the way. These short-term objectives can be used as one-shot one-kill trading and day trading, acting as that directional bias. So just because it's trading under the context of the long-term high doesn't mean we're going to have a flash crash and trade there within 1 or 2 days. When price finds a draw on liquidity, such as this external range liquidity pool, it walks and it trends towards that point with up candles and down candles, up candles and down candles, up candles and down candles. And that's because price, as it walks, price tends to get oversold and overbought. Okay, so you need to understand that the more we trade into the discounts, the more we could see retracements. So therefore, if you have an opportunity to take profit at a 1-to-1 swing projection and an internal range liquidity pool, you have to take something off, because price is in a discount and price is at a really cheap price. And obviously you can hold for long-term objectives, but just pay yourself for your time, your energy, and effort in the market instead of regretting it afterwards. It would also make a lot of ease and pressure on yourself as well when you take something off, and it will make holding for these long-term objectives a lot easier. Okay. Measured swing. So measured swings focus on failure swings. Okay, so let's recap what a failure swing is first. Failure swings are engineered moves. The intent behind them are to build a short-term discount and premium condition. Whilst building a short-term discount or premium condition, price will seek an intraday or week draw on liquidity. Therefore, the purpose of a failure swing is to build a discount premium whilst also meeting market making objectives. So let me just quickly explain this graphically if you didn't understand. Let's say we have a long-term level here, and let's say price is trending up towards that long-term level. Price breaks market structure with that significant market structure break. Now we have the long-term low, and we have a long-term high. Failure swings are engineered to build in this case, a short-term premium. So we're going to view this retracement into a premium, which is above 50% of this range. This move is a failure swing, okay? Because it's designed to fail in the future, following the narrative of the long-term high. The intent of this failure swing is just to build a premium market, so go above the 50%, okay? But whilst building that short-term premium price, trading into premium here, price will seek an intraday or intra-week drawn liquidity. So that could be trading back into a fair value gap. Okay, so that could have been the intraday drawn liquidity, trading it back into a fair value gap, or it could have been trading back into internal range liquidity or an order block. Nonetheless, it could have been an intraday drawn liquidity. When focusing on failure swings to trade back into a drawn liquidity, it's best to see, okay, is there a fair value gap, right? So you want to be aiming for that fair value gap for a rebalance, all right? Because when it rebalances, if we take a look at the structure in this case, we can see that we have a short-term high here, short-term high here, which makes this an even more significant long-term high, which tells us more that this is a very key turning point, right? So remember, rebalanced intermediate term swing points, and another one here, especially when this reacts with a long-term perspective level, that's going to form a very long-term high. Okay. So now instead of using the parent price range for targeting purposes, we're going to use and project out the failure swing for swing projections. So once again, if we have a long-term high here, a long-term low, this is the parent price range. Okay, we can also project that out for swing projections, but for measured swings, we're going to use a fader swing that trades back into a premium. In this case, we're going to get this low to this high, and we're going to project that out for targets, and we're going to blend them with price levels such as liquidity or fair value gaps. So first, let's establish some context from the long-term perspective. Here we have a range, low to high, discounted prices, last down candle in this range. Okay, so that's acting as a long-term perspective level. Within this long-term perspective level, we're blending it with the daily chart. Okay, because if we didn't know what's going on in the monthly, then the daily chart would be, well, it'd still be pretty clear, but if you really want clarity, then incorporate the monthly as well and blend it with a daily perspective like I've done here. So we have a high for breaking market structure. Okay, so that's an important high. If we're going to retrace, we're going to trace within this range. So when people draw out daily ranges, make sure that you're drawing it out from a high that's been taken out like this. Because if price trades towards this rebalance here and trades lower, that made a rebalanced high, which is key, right? And this is internal range liquidity. But if you're using this dealing range here, it's not a key high to be drawing out your dealing range. Alright? Because first of all, look to the left, it's clean. Second of all, it's going to stab up into this and rebalance this anyways. So there's no point of drawing your Fibonacci from this high to this low. Use a key high like this one here. So we're going to blend that monthly order block with a daily chart. What is the daily chart telling us? Well, if this is the range, prices, discounted prices, very cheap. We've taken out a low here, stop run, and we formed an aggressive order block, stabbed into it, and take a look at this. Order blocks breaking, okay, support holding. So what does that tell you about the monthly order block here and the stop run? So we have to find a narrative. Where does the market want to trade to? In this case, we have two areas that price could trade towards: liquidity pool and imbalance. So here we have internal range liquidity in form of premium highs, and we have an imbalance, and that's going to be the source of drawing liquidity. So when we're looking for day trades, we're going to be focusing on bullish bias. Alright, so take a look at how many bullish candles are here compared to the bearish candles. When the market is ready to reverse, this will be confirmed with a significant market structure break. So if we see a support level, price is going to decline and completely reverse that when we have a significant market structure break. So here, clean highs. Inside that monthly order block range, we taking out lows, which is a fake out. We cleanly close above these highs, which is the market structure break. This is a fader swing. Okay, what did this fader swing do? Created a short-term discount. We know that when price trades below low, this is extremely discounted, right? Especially looking at the context with the monthly order block. This is extremely discounted because everyone's going to be chasing down on the breakout and placing their stops above here. So this fader swing created a short-term discount by breaking here extremely cheap, and whilst doing it, inducing a ton of shorts in the market with breakout shorts, which then builds buy side liquidity up here. And if these guys are unwilling to, take the stop out, then they're just going to move up here, right? Or maybe this breakout was more of a long-term play, and they did put the stop up there. Okay, regardless, there's always going to be liquidity on breakouts. We can also use this as a fade swing. What did this move do? Traded back into discount market, inducing more shorts in the market, building buy side liquidity above here, right? So we could also project this high and this low for measured swing targets. All right, but we're going to specifically focus on this one now. So with the drawn liquidity, that's where we want to see price draw towards. And we have short-term targets such as this and this here. After the market structure break, right, we're going to use the fader swing, and we're going to project that out. So 0.5, and we're going to blend this with a price level. What do we have? Look to the left, nice fair value gap. So that could have been the first target. Now we're aiming for a 1-to-1 measured swing. Look to the left, we blend that with a fair value gap. $1.5, look to the left, we have a high here. And since this high is very low resistance, might as well just use these highs as well. Two standard deviations out. Blend that with price. What do we have? We have equilibrium price point, and we also have clean highs here. And finally, 2.5 and 3 projections on the measured swing using the failure swing here. Look to the left. We're finally in that premium condition. We're trading towards that drawn liquidity, but we're framing short-term trades on these swing projections, and we're blending with what needs to be rebalanced or what liquidity pools need to be taken out on the way to the drawn liquidity. Understand that sure, you could find one setup here, stop below here, and just hold the whole thing. But if we go back to this daily chart here, this is 1, 2, 3, 4, 5. 1, 2, 3, 4, 5 days of trading. Okay, so it depends on what style of trading you prefer. Are you a one shot, one kill trader where you enter at this order block here and you hold until this? Okay, are you a swing trader where you enter here and you hold for this entire range until the drawn liquidity? Or you're a day trader like me, we just want to get in, out, in, out, in, out. Because if you're a day trader like me and just want to get in and out, then this style of taking profits is perfect, right? Because if you got in here and you didn't get out here, price would have retraced against you and you would have lost all your unrealized profits. Now that wouldn't be an issue for a one shot, one kill trader or a swing trader, because he's holding for all the way up here. But if you're a day trader, you want to get in and get out, and you want to find logical areas to get out at. So now that we have context from a long-term perspective, confirmation with significant market structure breaks, and targets with swing projections, it's time to discuss how we can manage our trades as price heads towards our targets. Managing swing projections with institutional order flow. Let's start with intermediate term displacements to higher time frame targets. The first thing to understand is that after an intermediate term swing point has been established, that will cause a displacement to our swing projection targets. So therefore, we must trust price to trend and walk towards that target with subordinate order flow. Okay, so you can see here, rebalance intermediate term low. After that forms displacement, right? We can see, look at these up candles here. These are not displacements, right? These are not displacements. This is displacement, right? Displacement to our target, which is 0.5, and this fair value gap in a premium from this low to this high. Okay, so intermediate term displacement, when an intermediate term swing low has been established in this case, that will cause displacement toward our targets. Okay, same thing here. We have displacement and displacement here. Subordinate order flow is directly linked to the parent order flow. Okay, so all these displacements is because we had that long-term low here, which is from the long-term perspective. So since this is providing the bulk of the volume in the market, we are expecting to see those displacements happen. So the parent order flow is where the bulk of the volume is generated, and we are then navigating that volume from an intermediate term perspective. Okay, so this is the bulk of the volume, and this is the subordinate order flow. And we're going to navigate the bulk of the volume, which is just up, but since it has to walk, we're going to navigate that with intermediate term lows and highs. So let's talk about intermediate term retracements. Understand that the algorithm becomes oversold and overbought as it trends towards the targets. Therefore, it's important to keep your targets and profit taking nimble. So when price is in a premium here, these levels are high probability, okay? They will cause reactions. If you have premium prices and you have a fair value gap, bearish fair value gap in a premium, that will cause a reaction, okay? So make sure to keep profit taking nimble. You don't want to hold for too long, otherwise you'll get punished, like I mentioned, and you'll lose all your unrealized gains. So here we have a rebalanced intermediate term low. We're going to frame a trade setup with this intermediate term low, and we're just going to target 0.5 swing projections, and we're going to blend that with a fair value gap. So after that intermediate term low is formed, we can see we print an order block here. We have an aggressive retest on that order block. If you look closely, there's a fair value gap too. So order block, fair value gap, that's a high probability order block. You can enter here, stop here, and just target the 0.5 swing projection. So now we want to refine our risk, and that's the short-term perspective. Okay. So we can see here, midnight opens, we have an inducement. Market creates a Judas swing, induces breakout longs here, where they're going to place a stop loss here, here, and here. And since this is low resistance, we can expect this low to get taken out. Okay, so these lows are low resistance. So breakout longs, they're getting trapped in the market. Judas swing happens when? London session. Okay, and since it hit that fair value gap, this blue shaded area, that is a rebalanced intermediate term low. Okay, so we want to frame our trades upon that. Take a look at this. We're in London session. Price creates an order block by closing above this down candle. And that order block is high probability because we have a fair value gap as well. Short-term perspective, we can look for entries in a kill zone. Entry here, stop here, targeting that objective. Since the bias is up, every session we want to be looking for buys. So here we have the index market open at New York. Opens, creates that Judas swing. Judas swing, what does it do? Takes out a low into fair value gap. Rallies, prints another fair value gap here. Pyramid opportunity into that swing projection target. Okay. Now, if price is already in the premium market and price is expensive, you shouldn't be looking for longs in the afternoon. Okay. Especially when we're at a resistance level on the premium level. We shouldn't. So, as a reminder, it's important to keep your targets and profit taking nimble. Right? Don't be too greedy. It really depends on your style of trading though, but if you're a day trader, which I assume most of you will be, this is how you combat losing all those unrealized gains. Swing projections plus premium conditions plus a key level. Failures to do so might result in price retracing against your unrealized P&L. Retracements will occur at opposing levels influenced by time. So here, this fair value gap was opposing our bias in a kill zone. Yes, we're going to expect it to break in the grand scheme of things, but just take a look at when the market's going to close. Is the market going to trade higher when we're at the end of the market close, right? If it was pretty early, we can expect expansions. But when the daily close is about to come up, professional traders, they're looking to exit positions. And where's the most logical area to exit? Opposing levels, influenced by time. Why time? Well, we're about to close the day at a resistance level. So that's time and price. Here's an example of price retracing against you, causing you to lose all those unrealized gains, regardless your intermediate term low. Okay, so remember that, regardless your intermediate term low. Right? Let me explain. We understand that intermediate term swing points create displacement to higher time frame objectives. However, keep in mind, price might need to create multiple intermediate term swing points to get to these objectives. So we have one here, here, here. Okay? It's not just create one intermediate term swing low and then straight to our drawn liquidity. No, you might have to create multiple, right? When do we create multiple? Okay, once price starts hitting opposing levels. So when the premium here, what do we have here? Swing projection, fair value gap, that's opposing levels. We might need to retrace there. So it would be a good idea to close there. Price retraces, forms another intermediate term swing point. We understand, okay, that's going to form a displacement. Where? Well, we could start looking at a one-to-one extension here. Blend that with price action, fair value gap, and look at the range. We're in the premium market. Okay, that could offer a retracement. Okay, form another intermediate term low. We have a fair value gap here. Price forms intermediate term low here. Intermediate term lows form displacements to higher time frame levels. What do we have here? 1.5, 2, clearing the internal range liquidity pool here. Key intermediate term levels. Now we understand that retracements are possible. We want to manage our directional bias. Okay. So directional bias was formed on a long-term perspective using higher time frame levels. we want to manage that on the intermediate term perspective. This is done by studying if institutional order flow remains towards our drawn liquidity. So here we have two draws liquidity. We have price needs to rebalance, and if price clears that rebalance, we have the initial drawn liquidity on the daily chart. As price walks towards this area, we're using institutional order flow, and we're studying it to see if price wants to remain trading towards that area. Okay, so how do we do that? We study institutional order flow. If institutional order flow is bullish because we took out these lows and we had the market structure break, do you want to see rebalance intermediate term lows break? No, you don't want to see any bearish market structure breaks. If price did trade below a low, such as this one, bullish institutional order flow suggests that as a buy. Okay, why? Because we need to trade towards these areas. So if we're bullish, we want to see resistance levels break and support levels holding. That is institutional order flow in a nutshell. Resistance levels breaking, fair value gap, swing projection. All right, it's a target, but we're gonna expect it to break in the future. Same thing here, same thing here. Why? Because we need to trade towards these higher points, framed on a long-term perspective. Those key support levels are framed on the established intermediate term swing points. Okay, so when we're looking at institutional order flow and we want to study if support levels are holding, well, those support levels are framed on intermediate term low swing points. Okay, so here we want to see, okay, this low hold. We want to see this low hold. Okay, so supports, if this low holds, we break above this high now, form another intermediate term swing low, this must hold. So, framing support levels based on this low now. Form another intermediate term swing low here. Why? Because we rebalanced this point. So we want to frame support levels on that low, and we don't want to see that swing point break. Okay, same thing here. Rebalance low forms. We frame support levels on these lows. As we trade towards higher time frame objectives, we don't want to see these intermediate term swing points break, right? Because imagine if we hit a resistance level and we did saw a intermediate term low break, then that would be a significant market structure break, which is a clue for us when managing our directional bias. Okay, so if you're a swing trader or short-term one shot one kill trader, this part is very crucial to you. Now we must understand that we can't control price. We must allow price to do what it wants to do and trust it to trade towards the target. Okay, so we can't control this. Okay, we can't do anything. No matter how much emotion you're going to put into it, this thing's just going to do what it wants. No matter how much you pray to God, or how much you're crying, or how much you're angry, it's just going to do what it wants, okay? So you can't control it. The only thing you can control is yourself. So how can you do that? Well, place your trust in institutional order flow. Okay, and that's the beauty of interbank concepts. Interbank concepts allow you to trust institutional order flow. Resistance levels breaking, supports holding. That's the only thing you want to put your faith in. Okay, trusting institutional order flow is how you hold on these winning trades. So if you know that this thing is going to trade higher, and you're a swing trader, for instance, or you're one shot one kill trader, and you want to hold for these long-term objectives, you're going to have to trust institutional order flow. Trust the fact that, okay, supports will hold, resistance will break. Put your faith to that. And once you put your faith into that, and you're using these swing points as essentially like a call to action protocol. Let's say we have an intermediate term swing point here, and we're expecting this thing to trade high. Okay. If that intermediate term swing point breaks, that's a call to action that, oh shit, institutional order flow is probably switching. But when it comes to trusting it, right? Even if it pulls back against you like this, you know that this low is going to hold because it's an intermediate term low. And you know what's going to happen next. Displacement towards higher time frame targets. So you have to trust that. And to trust that, you just got to find as many examples and have as much wisdom and experience in the market. And then over time, you will trust it. And once you do trust it, it will remove your greed that causes you to take early profits, and remove your fear from getting stopped out because you're trusting that intermediate term swing point. Navigating and trusting institutional order flow. Framework. Step 1. Develop anticipation skills. So framework is built on the structure of an intermediate term swing point. This intermediate term swing point must follow the context from the long-term perspective. Okay, so you're not trading based off intermediate term swing highs, because those highs are expected to break due to the context and narrative of this long-term low. However, if you have a long-term low, significant market structure break, if price does form an intermediate term low, we're going to expect those things to hold, okay? Because it's following the context from the long-term perspective. And that's why we always start from the long-term perspective. So we know, okay, because this could be a rebalanced high, most definitely, right? This is a rebalanced high. So you have a fair value gap and it rebalances. So you would classify that as a intermediate term high. But due to the context of the long-term low, intermediate term highs are supposed to break and intermediate term lows are supposed to hold. Your expectations following that framework are sorted with institutional order flow. So if you're expecting bullish institutional order flow, trust, have faith, and anticipate support levels to hold, resistance levels to break, displacements higher after an intermediate term low. Bearish candles, such as this one, view them as speed bumps, right? Speed bumps before we accelerate higher. Speed bumps before we accelerate higher. Ask yourself the following. Did price establish an intermediate term swing high? Okay, so this is not following the example, but this is what you want to ask yourself when you're in front of the charts. Did price establish an intermediate term swing high? Then we should expect bearish institutional order flow. With bearish institutional order flow, resistance against the swing high should hold and support against the swing high should break. So if we have a higher time frame resistance level here and price breaks market structure, we have a long-term high here. Okay, we're tracing that. You want to wait for price to establish an intermediate term high, so a fair value gap. Let's say intermediate term high has been established here. We break low. From that point on, we'd classify it as an ITH. And what happens afterwards is bearish institutional order flow. Okay, so we're going to expect displacements to the downside. We're going to expect lows to break. We're going to expect up candles to send price lower. Up candles to send price lower after the intermediate term high forms. But this intermediate term high needs to be framed on the framework of the long-term perspective. Okay? Everything I explained here you flip it upside down for an intermediate term swing low. Framework, step 2, anticipating the daily range. So this is the beginning of framing your trading day. Before you start working within the daily range, intraday, you want to incorporate everything to give us clarity. Then we develop the skill of anticipating the daily range. So incorporate everything, like I said, everything prior to this episode. Okay? Then you'll develop the skill of anticipating the daily range. And if we're expecting bullish institutional order flow, we're expecting price to be bought on the daily opens, then displacement to the upside. Alright, so let's get into that. So here we have daily ranges. Here we see midnight opening, trades lower, displacement to upside into this level here, close of the day. Opens another day, trades lower, expansion to the upside with a displacement, trades lower, after hitting opposing level, closes the day, right? That's just bullish institutional order flow for you. So not only are we expecting resistance levels to break, supports to hold, we're also expecting price to be bought below the daily open. So ask yourself the following. Are we going to have a bearish power of 3? You want to ask yourself these questions before every trading day, by the way. Are we going to have a bearish power of 3? This means that a long-term high is providing the bulk of the volume to make daily candles trade lower. Because power 3 is daily candles. We want to see bullish failure swings above the opening price act as a Judas swing. We want to hunt setups within that failure swing. So let's explain this. If we're expecting this to be a long-term high, right? Long-term high means, okay, we're going to have bearish candles to the downside now. But how we're going to trade that is using the market opening price, which is midnight open. So midnight opening, we're going to expect a bullish failure swing, which is going to do what? Trade into a premium, induce longs into the market, and build stops below the market. Then, once price is doing that, we want to find shorts. Why? Because we're framing our trades based on the long-term perspective here. Then, when we look for shorts, since the long-term perspective says, okay, we're going to go lower, we're expecting all these next daily candles to trade lower with the power 3 fashion. Framework step 3. Hunting trading setups within kill zones. Finding a setup should be the easiest part due to the amount of context and framework we have behind us. Okay? This should be the easiest part, seriously. Now it's your job to find that entry pattern that stands out to you the most following the directional bias. If the trading pattern is present, fair value gap, order block, and you have completed each step of the frameworks, institutional order flow, power of 3, then when it comes to a kill zone, you need to pull the trigger. Once you pull the trigger, it's your job to relax on the trade and notice if you have any other psychological issues. So let's say you're in a trade and you're just feeling really itchy that you want to close the trade. That's a sign of greed, premature greed. Mark that down, right? Because there's repeating patterns in price action. but there's also repeating patterns in the things that you do as a trader. So when you make a mistake, it's pretty much the same mistake you've always made. So now it's time for you to write that down. Write that mistake down so that you can be aware of it. And awareness is always the first key step to solving these issues. If you do write it all down, that's gold. Like I said, you will then see repeating signs in trading flaws you might face that are not related to technical analysis. This will be solved with proper mindset and psychology training. So here we have the daily ranges, we have the bullish institutional order flow, we have the directional biases going higher into these targets that we marked out, and we're operating everything in the kill zone. So intermediate term low forms in the kill zone. This buy opportunity operates in the kill zone. Profit taking operates in the kill zone. Right? Here, consolidation. But the inducement happens in the kill zone, and another buying opportunity happens in the kill zone. Everything will happen in the kill zone. Make sure that whenever you're trading in the kill zone, you're finding your entry pattern, but it has to be aligned with everything you've done on the long-term perspective and the intermediate-term perspective. So here, I forgot to mention, always frame your trade on an intermediate-term low or intermediate-term swing point. So in this case, we have intermediate-term low. We're framing our trade on that. We have overnight rallies, AM retraces back into that order block. It's on the 1 hour chart. But that order block, price and displaces up, forms a fair value gap. Is that an entry pattern? Absolutely it is. Buys here. There's another buy here. Did we hit an opposing level yet? Not yet. So we can still look for buys. PM. Trades back to this fair value gap within the kill zone. Is that an entry pattern? Yes, it is. Buy. Take profit at that key level. And since I forgot to put, but this is after PM, you can see that price is not going to move. So you don't want to be looking for any entries out there because that's when there's no volume in the market. Kill zones will generate the most trading volume in the market. So, your action step. Set up your fib tool properly and save the preset. From a long-term perspective level, identify the significant market structure break, and using that context of the market structure break, find the new narrative, such as, are we going to trade below lows now, or we're going to rebalance, and blend it with swing projections for targets. So what I mean by this is, identify, let's say we have a resistance level here, identify the significant market structure break. Okay. From that market structure break, what's the new narrative? Are we going to trade below this low? Or are we going to rebalance this fair value gap here? Right? Whatever that is, find the new narrative. Where's it going to go next? Then, I want you to use the swing projections and blend it with those targets. So you can use the parent price range from this high to this low. Or you can use the fader swing from this low to this high and project that out. Or you can use this fader swing that hit the long-term level. So if you're wondering what the Fibonacci settings are, here they are. In your fib retracement tool, you want to have 0 and 1. Okay, so that'll mark out the range. Then you want to have negative 0.5, which is 0.5 standard deviations. You want negative 1, negative 1.5, negative 2, negative 2.5. But you're just blending all these standard deviations with price. So these mean nothing if you're not blending it with a key level, remember. Once you have all these numbers marked out, go over here and where it says template, You want to click that. You want to save it as swing projections targets. Swing projection targets. So with that being said, hopefully this video has been very clear for you guys, and I'll catch you in the next one.